If you are holding silver right now, there is a good chance you are being played and you do not even realize it. Silver exploded to an all-time high above $121 an ounce earlier this year. Then it crashed by nearly half. Right now it sits around $58, and the official story is simple. Fear faded, the dollar strengthened, prices fell. But here's what almost nobody is talking about. That story conveniently ignores everything happening beneath the surface, in the vaults, in the leasing markets, and inside the institutions that actually move this metal in size. If you only watch the price chart, you are watching the part of this story that retail investors are meant to see. Stay with me, because by the end of this video, you will understand what is really driving silver right now, and why the next move could catch most holders completely off guard. Let's start with what actually happened. Earlier this year, silver exploded to historic highs as the conflict with Iran sent shockwaves through energy markets and global risk sentiment. Oil spiked. Inflation fears spiked with it. Capital rushed into hard assets as a hedge against chaos. But here's what almost nobody's talking about. Once oil prices retreated back toward pre-conflict levels, much of that fear premium came out of silver just as fast as it went in. This is exactly why we saw such a brutal correction from the January peak. Now pay close attention, because this is where the story gets serious. A new Federal Reserve chair has taken a notably hawkish stance, reaffirming a commitment to bringing inflation down even as markets had priced in faster rate cuts. That hawkish tone has supported the dollar, and a stronger dollar almost always puts pressure on metals priced in dollars. At the same time, traders have been paring back expectations for near-term rate cuts, adding even more weight on silver in the short term. This is the surface-level story, the one most headlines are repeating. But underneath it, the structural picture has not changed at all. Silver has now been in a supply deficit for 6 consecutive years. Above-ground stockpiles are depleting. Industrial demand from solar, electronics, and electrification continues to climb relentlessly, and it is far less sensitive to short-term rate decisions than investment demand is. This changes everything for silver investors trying to make sense of this pullback. During the most intense period of the rally, leasing rates on physical silver spiked more than 30 times normal levels. Tariff-related disruptions caused regional shortages, with metal pulled out of exchange vaults and stockpiled domestically in American vaults. That kind of dislocation does not happen in a market that is fundamentally oversupplied. It happens in a market where physical metal is genuinely scarce. This is exactly why smart money is moving early, even during this correction. Because the structural deficit that drove prices to historic highs in the first place has not disappeared just because sentiment cooled. Now let's talk about the bigger picture, because silver is not moving in isolation. European and global central banks continue accumulating gold at a historic pace, a slow and deliberate shift away from over-reliance on the dollar and the euro as reserve currencies. Government debt levels across the United States, the United Kingdom, and the Eurozone remain at levels that would have seemed unthinkable a generation ago. Debt servicing costs are climbing faster than revenues in several major economies. None of that structural pressure was resolved by silver's pullback from $121 to $58. It was simply repriced. So what happens next? Let's walk through the realistic scenarios. In the bullish scenario, the supply deficit deepens further, industrial demand keeps climbing, and any dovish pivot from the Federal Reserve or a weakening dollar reignites investment flows, pushing silver back toward new highs over the coming year. In this scenario, the current consolidation around $58 would be remembered as the moment patient holders were rewarded, while the ones who panicked sold the bottom. In the bearish scenario, the Fed holds a hawkish line longer than expected. The dollar stays strong, and risk sentiment rotates back into equities, keeping silver range-bound or pressured for several more months. There's also a third, more likely scenario in the near term. Choppy, volatile consolidation, where silver trades in a wide range as it digests this massive correction, while the underlying deficit continues building pressure beneath the surface. What happens next could shock most investors, simply because so many are anchored to either the $121 peak or the fear generated by the drop from it, instead of looking at the structural scarcity underneath both numbers. Here's the truth most financial media will not tell you clearly. A 47% correction from a record high sounds terrifying, and that fear is exactly what gets retail holders shaken out at the worst possible moment. But silver is still up sharply year over year, still facing its 6th straight year of supply deficit, and still sitting in a world where central banks are quietly losing faith in fiat reserves. Those forces did not reverse just because the Iran conflict premium came out of the price. The investors who understand the difference between short-term dollar-driven pressure and long-term structural scarcity will be the ones positioned correctly when this market moves again. The ones reacting only to headlines about the drop from the highs are the ones being played. If this breakdown helped you see through the noise, make sure you are subscribed with notifications turned on, because this story is moving fast. Drop a comment with the word silver if you think $58 is a buying opportunity, or gold if you believe the bigger story right now is in the yellow metal. Stay sharp, stay informed, and we will see you in the next one.